Alrighty, there we go. We're off mute. Well, good morning, everybody. Welcome to today's episode of Canadian Mortgage Weekly. It is episode 74, and it's a really exciting episode because we are going to be continuing First Time Buyer Month by chatting today about the First Time Home Buyers Incentive. Um, I've worked with a number of first-time home buyers who, have used this program and have used this incentive to help them in their home ownership goal, get that initial purchase, and actually save on their monthly payments by using this program. So again, I'll be on the episode this morning by myself. Joe was not able to be on today's video, but I'm sure he's watching as well. So again, thank you guys so much for joining me this morning. And again, so I'll be chatting about the first time home buyer incentive. So first of all, before we get ahead, let's just chat a little bit about what this incentive is. So it is essentially just a shared equity loan from the government of Canada. So the first time home buyer incentive has been around for a few years now. And again, its goal was to assist home buyers, especially first time home buyers, lower those monthly mortgage payments by adding a shared equity loan to increase the minimum down payment that's made. So again, you still need to have that minimum 5% down payment, but with an additional down payment increase from the government, it can help to lower those payments, without you having to put any of your own money in additionally, or to make any payments. Again, it effectively lowers your monthly payment without having to increase the down payment that you're actually putting forward. So I think or again, let's just get in now to who it's for. So this program is, again, designed for first-time home buyers, meaning you haven't owned any properties. And you can also, and this is actually new to me that I learned while I was researching this program, is you can also qualify if you experienced a breakdown of a breakdown of a marriage or a common law partnership. So that's an important thing to note, because we do find, and unfortunately, separations and divorce has been a thing of COVID as well that we've seen an increase of. And we do actually find that that is a, part of the market that it does become difficult to qualify before, when you're in a home and you have a dual income family, it's a bit easier to sustain those sustain those payments. And, likely it was a huge influence in you getting that property in the first place. So the fact that this program actually can be used regardless of if you're a first time buyer, if you have been through a separation or, a breakdown of a marriage or common law relationship, it actually, I think, is extending a bit of options to those folks, because we do have a number of clients that come to us, currently going through a separation, either looking to buy the other out, or, they've decided to just sell the property, make it a clean break, but purchase something else. But we can find sometimes when they're only on their own, that getting to purchase a property, even if it's just a condo, can be quite difficult, and it can be straining on finances because that monthly mortgage payment is quite high, as we've seen those rates increase. So it's an interesting option, that I wasn't actually aware that the program was applicable for. So that's an important thing to note if that resonates and that's kind of what your status is currently. But let's chat about, how the incentive actually functions. So basically, if you're looking at purchasing a resale home as a first-time buyer, you will still need the minimum 5% down payment at least. And the government of Canada will give you an additional 5% loan towards the down payment. So bringing essentially your down payment amount from 5% to 10%. And if you're looking at purchasing a new build or buying a home from a contractor, you can choose to add either 5 or 10% towards the existing down payment that you already have. So we've seen that by adding an additional 5%, it effectively lowers your payment by approximately, and this is given on the same purchase price, one client with 5% down, the other client with about or sorry, with 10% down, 5% from themselves, and 5 from the incentive. It saves about $120 per month. But when you factor that out over the year, I know it doesn't really necessarily sound like much. It's not gonna, put you in the green, but it's gonna save you almost $1,500 per year just by having and taking advantage of this incentive. So it actually is an exciting program when you look at the cash flow savings that you have and the fact that that additional money that you're saving that would have just gone directly to the mortgage payment. That money is completely yours. And that's something that gives first-time buyers a little bit of freedom of what they want to do with that. I know that having a new property, it is definitely a good idea to start building that slush fund, that emergency fund that, in case the furnace kicks, AC kicks, something happens, there's those home upgrades. You're no longer in the renter mindset where, your landlord is responsible for that. But now as a first-time home buyer, it's good to have some extra money there. And it also can be put back on the mortgage in a prepayment. And the earlier that you can do this, the bigger effect it's going to have over the life of your mortgage. So if you get that, if you, budget for that $1,500 in the first year of savings, lump that on as a lump sum payment directly on the principal, it's going to be saving you a lot of interest that would typically compound and again, end up costing you way more. So that simple saving of $120 by using the program can save you quite a lot. And it's also important to note that the loan doesn't require any ongoing payments, and it doesn't accrue interest over the life of the mortgage. And I know that that's sometimes people's reservation when they're looking at other programs like the home buyer plan, which allows you to borrow from your RRSP. It's great that you can use that money completely tax-free, but at the end of the day, with the home buyer plan, it does require monthly ongoing payments to, basically replace the amount that you borrowed from your RRSP. So from this one, there's no additional payments that are required. And again, it doesn't accrue interest, but the repayment process happens at any point. If you sell your property, if you refinance for more money at an insured amount, then it does trigger a repayment. Even porting is going to trigger a repayment. So essentially at the end of that 25-year amortization, or at the time of the sale, breaking the mortgage, anything like that, it's going to trigger a repayment. And because it's a shared equity loan, that just means that the government of Canada is going to require a payment equal to, whether they gave 5 or 10% towards your down payment. They're going to require that 5 or 10% based on the appreciated value or the current value of your home. So if you see, an increase in your appreciated value, say from a purchase of $500,000 to $600,000, they're going to share in that gain, and they'll take 5% of the $600,000 appraised price versus the initial loan, which would have been 5% of the purchase price at $500,000. And it is also the same that because it's shared equity, they also, if the property loses value, they share in the loss as well. So again, this is another thing to expect and to keep in mind, even if you're planning on maybe refinancing, to take out some equity to, even if you're putting it back into your home in renovations or something like that, it's important to keep in mind that if you go through the first-time buyer incentive, any type of refinance or sale is likely going to trigger you to repay that full 5% amount. So it's important just to keep that in mind, as it's just an additional step in a typical refinance. And it's also important to note that the down payment cannot exceed 20%. This means that, with the additional amount from the government of Canada, including your existing down payment amount, the total combined can't exceed. So we have seen clients that, push it to, 19.9% down payment. They get the 5% from the first-time buyer incentive, and they fill in the rest. This again is just because the program requires it to be an insured mortgage, meaning it needs to be over 80% loan to value or under 20% for the down payment. So if you were planning on putting 20% down to save on that insurance premium, unfortunately, you won't be able to use the program. but it really does, again, give you a bit of that freedom for choosing what to do with your finances, giving you a bit of a break in terms of, what to do with that savings. And again, having the ability to put that back in as a prepayment, that lump sum amount really can help you out. So let's talk about qualifying. So we know how the program works. Again, it's been around for a while. So to qualify, you do again have to be a first-time home buyer, or again, if you were somebody who experienced a breakdown of your marriage or common law partnership, you can qualify. But there is also a maximum household income of $120,000. So this is again a total combined household income. So if it's a dual income family, maybe you're receiving CCB, all of those things have to be accounted for, and they have to be under $120,000. And as well, the maximum loan amount is capped off at 4 times your household income. So this just means that, say your household income was $100,000, your maximum mortgage, including insurance premium, cannot exceed $400,000 or 4 times your household income. So again, there is some restrictions and there is some some requirements to follow in order to qualify and get this mortgage and get this incentive. But if you're looking at purchasing in the GTA, in Vancouver, in Victoria, some of those really high price point areas, there is actually in a first-time homebuyer incentive 2.0. So if you're looking at a purchase in that area, they've increased the total household income, the maximum household income to $150,000. And they've also increased the maximum loan amount to 4.5 times your household income. So this is again just, it was released, I believe, last year, where it was an incentive increase or a bit of a boost to qualify in, again, some of those tougher price point areas where 4 times a maximum household income of 120,000 doesn't get you very far in the GTA, as many of you know. So with the first time home buyer incentive 2.0, it increases that maximum purchase price up to about 722,000, which is pretty close to what we're seeing as the average house price in Canada. So again, if you're able to get in at the Toronto market, this might actually give you a boost or a bit of a help to get into the market. So definitely let us know if you are a first-time home buyer, if you're interested in more about the incentive. We are also hosting a first-time home buyers webinar this evening at 7 p.m. Where I'll be covering off this exact first-time homebuyer incentive, as well as some other, grants, incentives, programs, and rebates that you qualify for as a first-time homebuyer. So if you are a first-time homebuyer, if you know somebody who is, if they want to get informed, or maybe just want to see, where's the market at, how can I actually beat these prices, you definitely want to check out tonight's webinar at 7. So either, send us an email, comment below, send us a DM, and again, we can definitely stay in touch to make sure that you're getting all of this information, because when we're seeing what prices and rates are at today, it's important to have a bit of an edge in the market and make sure that you're staying ahead of the game. All right, so now I'm going to transition over to our typical metrics that we go through every single week. Here on Canadian Mortgage Weekly, we look at the options of, where the rates are at, where they're headed, where we think they're going to be going. So let's kick it off here with looking at the 5-year bond yield. So you can see that it has been on the up and up. Again, if you've been tracking what the 5-year fixed rate is currently like, you've also been seeing and tracking that is on the up and up. The current bond yield closed yesterday at 2.82%. Again, up from last week's bond yield at 2.58%. So we're really, pushing the limits of this spike here. We had a little bit of a break where the bond yield was sitting at that 2.5% range, didn't really get, too much higher than, maybe 2.6. It was in a tightening range, but we have seen over the last couple of days that it has spiked and it's at that new high of 2.82. So if we can, extrapolate any information, it's likely indicating that we're going to see a continuation of increased fixed rates. Again, I know that over the last couple of weeks, sometimes it's multiple times in the same week that we've seen lenders raising that fixed rate. So if you at all are interested in getting into the market, this is, if anything, a cry for getting pre-approved. You want to get that rate hold so that if rates do go up anymore, you do have a protected amount. So if you're kind of sitting on the sidelines watching the market, just take a look at this graph here, and you're seeing that even since March, we've gone up from about 1.5% to 2.8%. So that's quite a substantial hike in a very short window. You can see the gradual increase from even September to January. It was a much softer approach, but yes, it's definitely an idea to get into a pre-approval, get a rate hold, because again, we're still expecting that fixed rate to continue rising. Looking over at the CDOR rate, so this is a market metric that we look at to give us an indication of, how good of an option a variable rate mortgage is. I know we have seen a lot of people questioning variable versus fixed, what's the right option? Well, we're seeing that, as of the data was last available, which is yesterday, the CDOR rate was sitting at 1.28%. So up actually a very small amount from last week's 1.23%, which actually is an indication of, maybe some a bit of a slowdown on the rate hikes. I know we just came out of a rate hike last week from the Bank of Canada, but typically the CDOR rate, we were looking at it increasing by about 0.2% every single week. So it was on a bit of a steady climb, but the fact that we're seeing it, slow down quite a bit is an indication that, maybe the variable rate is going to camp out here for a while. And again, the metric of how we use it is we look at its variance, or its variance from the prime rate. And with the Bank of Canada's interest rate hike, the prime rate is now sitting at 3.2%. So the variance is still under 2%, which indicates, that variable is still a really great option. You're still getting the most competitive rate by going with variable, even though it's still on the rise. It's risen the last two Bank of Canada rate announcements. It's still indicating through this metric that it's a good option, and it's a very competitive option to take. Again, as I had mentioned last week, we had a supersized rate hike from the Bank of Canada, increasing its overnight rate from 0.5 to 1%. So especially, this is important for, again, anyone with a variable rate that is an adjusted amount. They're likely going to see those, whether it's a line of credit, a variable rate car loan, obviously a variable rate mortgage, you're going to see those payments increase, unless you're at a static payment, which you'll see a change in your amortization. Again, we also got to see a bit of the monetary policy from the Bank of Canada, which just kind of highlighted that a lot of the primary drivers were supply constraints. We've seen at the pumps for sure, oil and natural gas price spikes, and of course, high inflation. So, all of these indicators, all of these things that are happening, these current events, contributed to a double rate hike. Some have called it a supersized rate hike of 0.5%. So if you want more information on that, feel free to check out our video from last week on Wednesday. We did a pre-rate show. We looked at some articles, what economists were saying, the kind of the lead up to the rate announcement where we saw that double point increase. And we also have some very exciting news, especially if you're a first-time home buyer. We did see the national house price average dip. So it went from a February average of $816,000 and dropped for March to $796,000. And yeah, exactly. That's been likely a good relief for a lot of first-time buyers. If you're already in the market, you already have a home purchased, we're still up year over year for March, about 11%. So, I mean, it's not like there was a huge loss, there was a crash, anything like that at all. Just on a month-to-month, a month-to-month glimpse, we did get to see that drop. So at the current average house price for March of 2022, the average household income needed is approximately $165,000 with a minimum down payment, not including closing costs, of $54,606. So it's still quite pricey to get into the market. You do have to have some good income on file. Maybe you need to have a cosigner. But it's nice to see for those first-time home buyers who thought, I mean, it is still quite high, but it's a little bit of relief from the trend that we were seeing before. You can see that big spike in the curve where we jumped from 760, I think it was 750, to over 800,000. We're back down to under 800,000, which again is reflected in the market, with real estate moving a little bit slow in the recent month. But definitely with a combination of rising rates, of house prices, the average house price dropping, it's, if anything, again, a signal to reach out to us and get ahead of what's happening in the market. I know, again, with these times, they're very unprecedented. People want to sit on the sidelines. They want to figure out, okay, what's happening? But at least by getting in the game, chatting with a mortgage professional, with myself, Joe Bladdock at the office, Terry Lynn at the office, any of us would be happy to chat about the options, as well as go through any questions. I know a lot of people have questions about variable versus fixed, whether they should get into the market now, wait for it. We would love to just chat with you about any of those questions or concerns that you have. And again, I do want to thank all of you for joining me this morning on episode 74 of Canadian Mortgage Weekly, Canada's video news podcast, where we again look at the metrics. We continue in the first-time home buyer month. Last week, we covered off the first home savings account, which is a new incentive introduced by the government. So check that video out as well. If you have any other comments or suggestions, please leave those comments below. And again, thank you so much for joining me this morning. It was a pleasure to bring this information to you guys, and I hope you have a great